Should we think of the FHA loan as kind of the starter loan, but anybody can use it along the way? People can use it for their second and third house, right?
Absolutely. Yes, it's not limited to first-time home buyers. I try to make
Yeah.
sure each client is educated during the process. They don't
Yeah.
have to know it all, but they want to know that they've got the best loan for themselves. And so they can
Yeah.
feel good when they're making that payment that they got a good deal.
Hey there. Are you buying a house and you're thinking about the loan process and you're not quite sure where to start? Today, we're going to talk with Rebecca Pierce from New American Funding about the three main kinds of loans. And we're going to make it short and sweet and easy because maybe you're kind of thinking about buying a home, but you haven't really even launched that whole rocket yet. Like it hasn't really happened. Or you're just curious about talking about loans. So we're going to keep it basic today and keep it kind of fun. This is a shorter video. And Rebecca Pierce from New American Funding, you'll see her a lot on my channel because we worked together for a long time. And she's great at helping people really understand what loans are best for them. So she's waiting over here. Let's get on with it with Rebecca Pierce. All right, so we're talking about loans today and what are the best kind of loans for you when you're buying a house. And this information changes constantly. So we don't really know if you're watching this in April of 2023 or 24 or 25, but the basic rules, concepts, and ideas about the different kinds of loans somewhat stay the same. Am I right?
Yes, you are.
Okay, okay. And by the way, I'm talking with Rebecca, great lender with New American Funding, and she's going to shed some light on loans and some parts of loans that I don't think the everyday guy might think about. Like we hear conventional loan and we might hear FHA sometimes in the news or something, but we're going to talk about some other stuff too. So I'm going to let Rebecca get going here and we'll just talk about maybe the different categories of loans. So we've got the conventional and the government.
Okay, that's a great place to start. So on a conventional loan, someone can go up to as much as a 97% loan to value. So that means they only put 3% down. So that's a great option for people. But this is also the kind of loan that people put 20% down, 30% down. Maybe they're selling a house and putting a big chunk down. So that is the conventional conforming type loan. It conforms to Fannie and Freddie government guidelines.
Okay, and it's more flexible for people.
It is. It's very flexible.
In
Every
that there's not like one set amount of money you have to put down on a house. I
No,
mean,
there's not.
when you put more down and the bank, like 20%, people always think, oh, I have to put 20% down. But not necessarily. You could put 10, 3, 5,
Yes.
anything in between.
Yeah, that's a great point. A lot of people feel like, oh, I've got to put 20% down. You know what 20% down allows you to have? No mortgage insurance.
Yes, and we talk about mortgage insurance because it's a little bit extra on your mortgage payment every month, but what did it do? It allowed you to get the house by by not putting as much money down. Talk about that because that's helped you get a lot of our clients into their first home.
Absolutely. So mortgage insurance is based on a credit score. It's based on the loan to value. Those are the biggest factors in mortgage insurance. So if somebody's got a really high score and they're still putting just 5% down, that mortgage insurance is not all that much. So maybe it's better for them to put 10% down than 20% down. And most of the time it's a tax write-off. So check with your tax accountant to find.
Ah, we love this. And we're talking 100 to 300 more a month maybe on
Oh,
your mortgage payment.
not even that much. No,
Not even that. Okay, because I have seen them in the 250 range kinda a lot, but if they put more 10% down and they had perfect credit.
right. So there are several different companies that you can choose from for mortgage insurance, and all of them vary just a little bit.
Right, right.
Right.
And this is something you talk about with people when you're helping them plan out what loan's gonna work for them.
Absolutely.
And, Yeah, I'm sure the average everyday buyer has not really thought of this. I mean, I get into conversations where, well, we've got our 20% saved, or we'll never get it saved. I
Yeah,
feel like it's just not going to happen. And this is a way to put 3% down or
right.
4%. You have awesome credit score, pay a little bit of insurance. Because talk about why there's mortgage insurance.
Okay,
What's the bank
so
doing with that?
right. Anytime you don't put 20% down, it's a higher risk for that end investor. And so the mortgage insurance protects them up to that 80% in case you default. So then they
Uh,
know that they're going to be able to get a portion of their money back. So it's an insurance policy. And what I would like to cover is that even if you get mortgage insurance, after 2 years of having the mortgage insurance, if you have enough equity in your home, you can drop mortgage insurance
aha.
without refinancing.
So it's not a forever thing. So you could refinance if life happened to offer us lower interest rates.
That's right. Or just that you get equity in your home.
Right, right.
Yeah,
So if it was like $100 PMI and you paid it for 2 years, that's 2,400 bucks, but you got to get into your house.
that's right. And the values come
Right.
up during that 2 years.
Uh-huh.
It's
And your
worth
value's gone up. So
mhm.
yeah, so sometimes it's worth it. And I shouldn't even say worth it. It's kind of always worth it because you got into a house, right?
That's right. You're not
Yeah,
paying someone else's mortgage.
I know. I
Yeah.
know. And so, yeah, and you can work that out. I think you just said that with if people are taking a bigger chunk of money, maybe 11, 12, 15%, but not 20, they're still going to probably have a lower mortgage payment, but and they'll have that little PMI added on, but they won't really feel it.
No, no. And then there's the next world is going into government loans.
Uh-huh.
So that's where a lot of people don't understand. They think a government loan is an FHA, and FHA is a government loan, but there are multiple. So we have an FHA, we have VA for veterans, we have
Uh-huh.
USDA, and that's for rural areas. And then we also have a portion of FHA that's for Native Americans.
Right, which we've touched on. I've never done one, but if
Right.
you're a Native American and you happen to catch this video, there's special loans you can get
That's
called a
right.
what's it called? 201
The Native American is 184. It's a 180.
184 is the title of the type of loan. Am I
That's
correct?
right. Right. What you're thinking of is the rehab loan. That's a 2 or 3K loan. And we also do the rehab loans, and then we also do construction loans, either FHA or conventional, and even VA.
Uh-huh.
So there's a lot of
Right,
options.
right. A lot of choices depending on what you want to do. So conventional loans are pulling from investors' money.
That's right.
And the government money is federal money that's being offered up so Americans can own homes and
It's
helping you out.
a type of loan. It's a type of
It's
loan
the,
that was set up by the government to begin with. There
yeah,
is an FHA upfront fee that the FHA, the Federal Housing Association, gets for doing an FHA loan to keep the
ah,
program going.
okay.
So
Would you say, I think in all my years selling now, we do a lot of FHA loans, right?
we do quite a bit. I would say maybe a
I
quarter
don't
to
know.
a third of the loans are FHA.
Yeah.
And let me tell you, the people that fit into FHA are those that don't have as high a credit score, or they don't have as much income. The debt to income ratios can be higher. A lot of first time home buyers fall into that or fit into that because they don't have a mortgage to help their credit score out. So when you get a mortgage, then that starts helping your credit score. So when it's time to refinance, usually they'll refinance into a conventional loan that doesn't have that mortgage insurance or not as high.
Right, right. Okay, so should we think of the FHA loan as kind of the starter loan, but anybody can use it along the way. People can use it for their second and third house, right?
Absolutely. Yes, it's
Yeah,
not
yeah.
limited to first-time home buyers.
Right, right, right. A lot of it kind of anybody can use it at any point in their life, right?
They can. They
Yeah,
can.
yeah. But we know it's really attractive to the first time buyer,
It is.
especially in Sonoma County because it's a tougher hill to climb to buy a house, and
Right.
but you can do it because you only have to come up with 3% down,
It's
right?
actually FHA is 3.5% down,
3.5. Yeah.
and if you go conventional, it's 3% down is the minimum.
Oh wow.
So
Yeah.
conventional will actually go a little less. The Native American loans is only 2.5% down,
Wow.
and if you're a veteran, it's on 0 down. It's 100% financing.
Yes, if you've served our country in
Yes.
any of the fantastic branches, uh,
Right.
look into that VA loan because you don't have to come up with a down payment, right?
Right, you have to come up with
And
eligibility, and those veterans that have been disabled, there's no upfront fee for going VA.
it's really fantastic. And the seller has to sell you the house in really awesome shape. They actually have to agree to sell to someone using a VA loan, and then they have to do the checkoff list of everything working and in great shape. So
Right,
it's a true win-win for a vet, right?
right, right,
We're,
and the other
we're
100% financing is USDA. So USDA with
yeah.
100% financing as well.
And those are interesting. We've discussed those before in other videos, but in some cities and certain areas, you can use the U.S. Department of Agriculture. I know that's weird, but they loan money for home buying. But sometimes the house isn't like proper in the city proper where you live. It
That's right,
might be on the outskirts and more rural. It's called a rural loan, you just said, right?
that's right, that's right.
Yeah. But it might not be 15 miles from town. It could be.
Exactly,
You can actually get on their map, which I'll put as a link below here, and see where the parameters are.
right.
It's pretty easy to understand. So, yeah, so there's so many great government loan options for anybody. And we were going to talk about the non-conforming loan, which I don't talk about a lot, but you're an expert on it. So let's talk about the non-conforming loan, which the jumbo loan is a part of.
Yes,
And we live in, Sonoma County with the $1 million homes. So
yes,
someone might have to get a high level home, high price loan.
right.
And so, all right, go start in.
Okay, yes. So the jumbo world, it also the non-conforming world includes the jumbo products. It includes the I-10s for those that don't have citizenship but are in the country legally and pay their taxes. They can also get a loan, and also bank statement programs. So those that do their taxes or but maybe haven't done them yet or can prove more income on their bank statements, then we can actually get approved bank statement program. So there's a quite a few in this non-conforming world. And what that means is it doesn't fit into that conventional box or that government box. It's outside that. So it's a non-conforming loan.
So the conventional box, you have to have your copy of your taxes. You might have to have a copy of your Schwab account or a trust or like proof of your income. Your what is it, twos or nines or something?
W-2s. Yes.
W-2s.
Yes.
So you have to have these all in order and send to you.
Yes.
And that's how you determine what people qualify for.
That's
But
right.
there's people that don't have all that stuff.
Right.
And so, but they could still qualify to get a loan because they've got the money to get a loan,
Yes.
enough to get a loan and enough to qualify. And so it doesn't conform to normal standards.
That's right.
No one ever thinks about this. I mean, except for bankers and you.
Right. That's why you want to talk to a loan consultant because there's so many
I
options.
know. I
Yeah.
know. And so you mentioned the bank, it's a bank statement product. Is that what you
Yeah.
call it? So
Yeah.
they have to produce bank statements going, tell me about that.
So sometimes it's going back for 12 months and they're going to look
Mhm.
at the income for those 12 months. And then they'll also look at the the expenses that go out. And then also there's a 24-month program. So you have an option of one or the other, depending on your credit score, how much you put down, to which program works for you.
So you only use bank statements? That's it? They don't have to like show you their Schwab or their
They're gonna
401?
Yes, they're gonna show us their assets for closing. So if they're putting
Oh,
$250,000 down, we do have to see that. But qualify them for income, we can qualify them based on the income that they receive on their bank statements.
interesting. Kind of simpler in a way.
It can be.
It can be. So, yeah, because people that are self-employed and what have you, they pay quarterly taxes and maybe they decide they found a house and they haven't paid their taxes. So they're not really going to have that stuff. And when you provide tax information, it has to be the most current. So they couldn't use last year's taxes.
Well, on some programs you can.
Ah,
If like right now we are in an extended tax credit time where our taxes are not due until October, and
right.
there's flooding in the state of California. So somebody may not file the taxes until October. So we would use the last 2 years, but not 22, but 20 and 21's income. And
Ah,
maybe that wasn't as high. Maybe 22's income was so much higher. And so therefore we might use 12 months bank statements for this person.
hmm.
Right.
Right. So the importance of having a great loan officer.
Yes.
Because there's lots of choices and you kind of just have to sift through it with you.
That's right.
Um, and ultimately come out with a mortgage payment every month that people feel comfortable with.
Absolutely.
Yeah. Because in the past, I mean, there was all the stuff of, I think a lot of people walked away from loans thinking, or walked away with a loan thinking, this is over my head.
Right.
I'm not going to sleep at night. I need to find a 10th job, right? And we're
Right.
not doing that stuff anymore, right?
Right. Well,
No.
I know in the past, when the rates were kind of mediocre and people could get a lower rate on a 15-year loan, then
Yeah.
some people went to a 15-year loan, and then the crash hit of 2008, 2009, all in that time frame, and then people couldn't make that payment.
I
So
know.
that's what happened to a lot of people because you don't have the income, you can't refinance it even into a 30-year. So
Yeah, and there's protections against that now, right? Like waiting periods and stuff. So the consumer, the buyer can ask you questions and review things and understand what they're getting, the product they just bought.
right. I try to
Yeah.
make sure each client is educated during the process. They don't
Yeah.
have to know it all, but they want to know that they've got the best loan for themselves. And so they
Yeah.
can feel good when they're making that payment that they got a good deal and they feel good.
Yeah. So huge because it's the thing. I mean, once I hand you keys, you're left with a mortgage payment.
You get to have a mortgage payment.
Woo! And you're excited, but you're kind of like, whoa. And
Right.
yeah, and I know Rebecca and I both like everybody to be like, yeah, we can do that. It's not much more than our rent was,
Right.
you know. And that's one of the first things I tell people to when they talk to you is like, okay, our rent is 3,200 now
Right.
or 2,800, and we're perfectly fine with that. We can save still, and yeah, super important to sift through in the process. So being calm and having a great mortgage payment, and being able to call you at any time during the process and even afterwards, 6 months, 8 months later, and talk about that statement you've now been seeing for
Absolutely.
oh, well, it's important to know, like, you didn't just think of your loan officer as like, okay, that's one and done.
No, I like to check
With
in
them for
once
life.
a year. Yeah, I like to check in
Yeah,
once a year to make sure that they are in good standing,
yeah,
just remind them about things that they may not have thought about. And
yeah,
where it's in my industry, it's my wheelhouse. So I like
yeah.
to be able to share that with others.
Because we know that first year of owning a house, even if it's your second house, There's a lot of adjusting to do, but first time buyers are like, well, there's no landlord anymore, no safety net. You're doing this, you're like buying your house. So,
Mm.
yeah, knowing that you can call either Rebecca or me and we'll answer questions, help you get resources for anything you might need. But it's just great when it comes to the loan that you're kind of being followed up on
Mhm.
and someone's thinking of you, because writing that check every month is really something. And or sometimes it's auto paid. We don't write checks anymore. I just read an article about how checks are dangerous.
Oh,
And I'm like, oh, now we're talking about only do digital. I know that probably happened 2 years ago, but it takes a while to sink in when a lot of people have been paying that mortgage payment every month with a piece of paper. So I know if you're 22, you're like, what? I do everything on the computer, but hasn't been that way. So, yeah, so we'll be checking up on you and making sure that you've landed softly and you're still good a year later and everything's working, right?
right.
Yeah,
Absolutely.
yeah, yeah. Anything else about loans did we cover? We're
I don't
kind of
think
good.
so.
The
Yeah.
government and the non-conforming
Well, and the conventional loans. So
and the
you
convention.
yes, you have
Yeah.
3 programs, the conventional, the government loans, and the non-conforming loans.
And you'll notice in this video, we're not talking about prices and a jumbo loan is this now and that now, because you might be watching this a year or two after we record it. And so everything we say is going to be the same, but prices, interest rates, levels that you can get a loan and all that stuff changes all the time. So, but just know that these are the 3 kinds of loans, and we'll find one for you, right?
Absolutely.
So do you like a free relocation guide and a buyer's guide? Well, right below the video is a free relocation guide just for you. So scroll down, and while you're down there, give me a like, hit the subscribe button, and the next video is coming up right there.